Hi guys, welcome back to TipRanks. My name is Annika and here at TipRanks we love to hear what different stocks you're looking at and your opinions on the market sentiment. In this video we're going to look at two wildly oversold stocks that could explode higher. Now before we jump into this video, you guys don't forget to hit that like button and that subscribe button and that bell notification so that you get informed on when the TipRanks channel releases a video. Now the stock market is usually a case of reverse psychology exercise. When stock prices go up, that's when people want to buy in. But when the stock price goes down, people's natural inclination is to shy away and panic sell. But as investors, now you may already know that you need to actually fight against these natural impulses. In fact, when the prices are low, that's when we get the largest discounts and the largest upside potential to our investments. Of course, not all stock prices that are sitting at super low prices are worth buying. They need to be fundamentally strong. In short, they need to be undervalued, which means that their fundamentals are there, but this strong fundamentals is not yet reflected in the stock price. So rounding up some of the Wall Street analyst consensus, they have selected two stocks that are worth buying. And these particular stocks have been highly oversold, meaning they have real room to run when it comes to their price potential. The first stock is TG Therapeutics and its ticker is TGTX. TG Therapeutics is a biotech company. They focus on novel and non-chemotherapy therapies for patients with B-cell malignancies and autoimmune diseases. The current price for TGTX is $11. The analyst rating consensus is a strong buy, with 7 a buy rating and 1 a sell. The analyst price target on TGTX is $41.20. This is a 274.55% upside based on 8 Wall Street analysts offering 12-month price targets. The shares of this biotech were already on the back foot throughout 2021, and in late January, the company released some news which accelerated this slide. The company disclosed that the FDA had put a partial clinical hold on the studies of U2, a combination of UKONIQ, umbralisib, and ublituximab, being tested as a treatment for chronic lymphocytic leukemia, CLL, and non-Hodgkin's lymphoma, NHL. TGTX stressed that the hold was not due to new information which came to light, but on previous worries, which will be addressed at an Oncologic Drugs Advisory Committee gathering in March or April of 2022. They also didn't have some great financials this year. Looking at their product revenue, the net was approximately $2 million and $4.3 million for the 3 months and 9 months ended September 30, 2021. Most of their product revenues represent US sales from their sole commercial product, UKONIC, which received accelerated approval from the FDA on February 5, 2021. They are, however, operating still at a net loss. The net loss was $85.6 million and $254.8 million for the 3 and 9 months ended September 30, 2021, compared to the $87.2 million and $191.2 million for the 3 and 9 months ended September 30th in 2020. So you can see that their net losses have increased in the last previously reported quarter compared to the year ago quarter. However, it is reassuring seeing that they have a cash and cash equivalent of $381.4 million as of September 30, 2021, which would be sufficient enough to fund the company's planned operations into 2023. JP Morgan analyst Eric Joseph is bullish on this stock. He said that, to be clear, we do not believe the partial hold bears incremental weight on the direction of ODAC panel itself and should resolve favorably in the event U2 is approved. He reiterates how much this stock has been oversold. Joseph said that due to the setback, expectations have been lowered regarding the opportunity of ublituximab in RMS, which is set for PDUFA date later in the year. But this analyst thinks that the bearish sentiment is unmerited and believes that little, if any, of the agency's concern over U2 reads through to RMS. He said that notwithstanding the added negative sentiment for the update and growing investor frustration, we continue to view TGTX shares as oversold for RMS commercial potential alone into the 9/28 PDUFA date, with current levels regarded as an attractive entry point. Sometimes in the market, when shares are oversold, it tends to follow in exaggerated manners that more traders tend to sell the share more. This generally indicates panic selling. When you see some people selling shares, you panic and people don't want to have losses that are further than they were expecting. But in actual fact, when things are oversold, it gives us the greatest discounts, especially if the fundamentals of that company have not really changed. Perhaps they had setbacks. For example, with TGTX stock, they had the setback with the FDA approval being put on hold. This is what makes it an attractive entry point. So guys, that brings us on to our second stock. This second stock is Fathom Holdings, and its ticker is FTHM. Fathom Holdings is a tech company operating in the real estate sector. The company offers cloud-based real estate brokerage services and operates IntelliAgent, a real estate technology platform. IntelliAgent provides brokerage and agent-level tools. It offers business intelligence and reporting, training, and customer relationship management, amongst other features. And they recently, on January 25th, Fathom Realty launched IntelliAgent 2.0. This is the company's next-generation proprietary all-in-one technology platform designed to simplify all aspects of brokerage operations and agent transaction management. In short, it's a CRM system, sort of like Salesforce. The current price for FTHM is $15.58. The analyst rating consensus is a moderate buy, and the analyst price target is $40, which is a whopping 156.74% upside. A lot of agents are keen on working with Fathom, given it has a focus on sharing a bigger chunk of the transaction when it comes to commission, as well as receiving a flat fee per transaction. The company has a footprint in over 23 states, and it claims to be the US's 9th largest independent brokerage. And not to mention, they had a stellar Q3 2021 results. They reported 81% growth in revenue. Their quarterly revenue passed $100 million for the first time. They also saw 50% agent growth, 42% in transaction growth, and their real estate network grew from 5,026 agents to now 7,536 agents. However, despite this, they have seen their share price fall. However, this could be because growth stocks have been kind of out of favor for the past year. And with the company not turning a profit yet, and the market is in a risk-off mode, the shares have lost 74% of their value over the period, despite the positive earnings report we saw. Roth Capital analyst Darren Aftahi likes the current setup and notes the shares continue to look oversold given growth opportunities. He gives it a buy rating with a $40 price target, which is a 159.74% upside. He says that the risk of rising interest rates and capital raise have seen shares weaken. But that said, we continue to believe that FTHM remains attractive now with the overhang removed and the solidified balance sheet. We believe that ancillary services could add to aid the top-line mix and thus incremental gross margins. A housing slowdown could see FTHM show its true colors in agent acquisition, all while capturing more wallet share per transaction, the latter a core pillar to our positive outlook. So guys, let us know what you think of these two stocks. Do you think they are a buy? And if you guys made it this far, don't forget to hit that like button and the subscribe button and that bell notification so that you get informed on when the TipRanks channel releases a video. Remember, this is not financial advice. I'll see you guys in the next video. Bye!